Do you want to know how millionaires continue to make fortunes in spite of a lot of twists and turns that happen during stock market crashes? With the decline of the S&P 500 falling by more than 20% in the year 2022, many investors believe that we're simply at the start of a far deeper recession, like Michael Burry, Jamie Dimon, Ray Dalio, and of course, Warren Buffett. The recession has surely hit every one of us in a negative way, but there are actually some ways to make the best out of the worst. Well, I'm sure you're highly interested, so sit back, relax, and enjoy as we venture into Warren Buffett's rules on how to make a fortune during the recession. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Don't forget to hit the subscribe button so that you'll be the first to know whether we upload a new video. Now let's get right into the video. In this video, we are going to examine 5 of Warren Buffett's insights that may be used to boost portfolio results even in volatile market conditions. Warren began his explanation by saying, "Irrational things can persist for a while, but they always die out." He explained, "I'm referring to the web here. These enterprises were selling for billions of dollars without any reasonable likelihood of turning a profit in the foreseeable future. A bubble, to be precise. And based on what we have observed so far, the bull run of the previous few years is over." Rule number 1. Don't panic. First of all, remember that panic selling is something to be cautious about, but definitely not something we should be afraid of. Warren advised that anyone who is emotionally invested in stock prices should not be a stockholder. You shouldn't buy stocks if you're going to make irrational decisions every time the value of your portfolio drops. For example, in the case of selling a property, it's not for sale because someone gave you a secret code. You look at the home objectively, and then you make a wise choice. Perhaps not everyone can handle the emotional and psychological demands of stock ownership. Warren, on the other hand, thinks that equities are safer than bonds over the long term if you take the time to learn about the company you're investing in and hang on to the stock for a while. Additionally, Buffett also quoted Ben Graham's Mr. Market during the dip. Would you sell your home to a nosy neighbor who keeps sticking his head over the fence and making you offers of $700,000 one day, then proceeds to offer $400 the next? Just because he's worried the real estate market is about to crash? We can rule it out right away. You enter, and life goes on. Why give up the ownership of a successful business for less than it's worth? That's completely out of their minds. While it's natural to feel uneasy when the market takes a dip, it's important not to panic. Remember, the stock market is cyclical, and crashes are a normal part of the investing cycle. History has shown that the market always bounces back, often stronger than before. So, instead of giving in to fear, stay calm and trust in your investment strategy. Keep a long-term perspective, and remember that patience and discipline are key to success in the stock market. Rule number 2. Always grab the opportunity. The second lesson from Buffett was this. He said, "The stock market is the only place where investors bolt out of the store during a sale." Such an argument is based on faulty premises and cannot be taken seriously. Don't be that person who sells a stock just because the fundamentals have shifted. The only time you should get rid of a firm is if its value has dropped because of a problem that will prevent it from making money in the future. Permission rather than a commission. The market may fall sometimes, although significant dips caused by external factors are unusual. As you may be aware, the most recent major market crash occurred somewhere in the late 2000s. He could be right that it was a significant one, but all it did was make it easier to fairly value businesses. As a result, it drives down the value of nearly all businesses, or in other words, making them cheap. Quite inexpensive for what it was back in the early 2000s. That's like 2 great chances in a long time. And honestly, that's quite rare. In the stock market, timing is everything. Opportunities can present themselves at any moment, and it's up to you to seize them. Whether it's a hot new tech stock or a traditional blue chip company, Always be prepared to act quickly and decisively. Don't let fear or hesitation hold you back. Trust your research and your instincts, and be ready to jump on that opportunity when it presents itself. Remember, in the stock market, fortune favors the bold. Rule number 3. Do a lot of research. The third takeaway from Warren is also well known. I'm of the old school of thought that says I can only hope to make money doing things that interest me. In addition, I don't only mean knowing how the product functions. To clarify, I am familiar with how the corporate economy, or the economy in general, is expected to develop in the future. He also saw parallels between Wrigley's and the World Wide Web. People's habits of chewing gum are not going to be altered because of the internet. Just their choice of gum will shift. If you have popular brands like Double Mint and Juicy Fruit, you can be assured that your share of the gum market will remain stable for the foreseeable future. While I can't say with any degree of certainty how Wrigley's sales will turn out, I also won't be too far off. My expertise is within the realm of assessing the merits of that firm. I am familiar with the market and am aware of the competitive landscape. That's according to Warren Buffett. When the market crashes, many businesses may announce bankruptcy, thus this is crucial information to have. There was a time when airlines, travel companies, and cruise lines were all in the news. But successful technological enterprises are currently in the spotlight. Yet you should never put your money into a corporation you don't fully understand, no matter how inexpensive it may be. You may have made a bad investment if you bought Bear Stearns or Lehman Brothers stocks when they were dirt cheap. If you want to avoid losing money during market crashes, you need to make sure you have a firm grasp on what's happening. When it comes to investing, there's no such thing as too much information. The more you know about a company, its industry, and the broader market, the better equipped you'll be to make informed decisions about where to put your money. Research can take many forms. You can read financial reports, watch industry trends, and analyze data to better understand a company's financial health and growth prospects. You can also seek out expert opinions and perspectives to help you make sense of market fluctuations and economic conditions. The bottom line is this: if you want to make money in the stock market, you need to do your homework. Investing without proper research is like playing the lottery. You might get lucky, but the odds are against you. So take the time to gather information, analyze it, and make informed decisions. Your portfolio and your bank account will thank you. Rule number 4. Choose wisely. Now on to the fourth insight on the list. The words of Warren were, based on what Ben Graham taught me about quantitative investing, I set out to find what I like to call the cigar butts of the stock market. A cigar butt investment strategy is like finding a wet, unattractive cigar while out shopping for smokes. It's awful that you pick it up and take a puff from it. Something which you discard is inexpensive or perhaps free. Then you start searching for another wet cigarette to puff on. That's what I did for a long time, and it was a mistake because it's so much simpler nowadays to acquire excellent firms at a reasonable price. These days, I'd rather pay a reasonable amount for a terrific company than a hefty discount for a mediocre one. On the other hand, I was a stock buyer back in the day when prices were low. Plant and machinery were free, while inventories and receivables were discounted because Berkshire was selling at a price below its working capital per share. In the current day, success favors the visually appealing, thus it seems sensible that you would choose to work in such an industry. Because of compounding, it generates more revenue and pays you more over time. Warren suggested that this is the prime enemy of bad business. Investing in the stock market can be a bit of a roller coaster ride, but there's always some risk involved. But one way to minimize that risk is by investing in high-quality companies that are well-positioned for long-term success. These companies tend to have strong fundamentals, such as a proven track record of profitability, a solid balance sheet, and a competitive advantage in their industry. Investing in good companies not only helps you reduce risk, but can also lead to bigger returns over time. As these companies grow and expand, their stock prices tend to increase as well. meaning you can profit from your investment. So when you're looking to invest in the stock market, be sure to do your research and choose good companies with a strong foundation. Rule number 5. Think big, think long term. And now on to the 5th lesson imparted by Warren Buffett. Buffett's last lesson is heavily centered on setting and achieving long-term objectives. And the securities markets are no exception to what he said you would witness in your lifetime. Despite these massive waves, the country's long-term prospects are bright. You don't need to be very intelligent to get wealthy as long as you maintain objectivity throughout that and can emotionally separate yourself from the herd. But here's the thing. Intelligence alone isn't enough. You also need the right disposition. If you think about it, the faster a market falls during a collapse, the more individuals are trying to get out at the same moment. Therefore, you need to be the type of person who can put money into the market without worrying about where it will be next week or next month or in the next 4 months. Instead, you should be the one to focus on the big picture. Think of how your money can grow over the duration of 5, 10, 15 years or even more. If you can do that, you'll have a much simpler time investing during market downturns. Keep your focus on the long term. It's easy to get caught up in short-term fluctuations and daily news headlines. But successful investors know that the real money is made by identifying high-quality companies with strong fundamentals and holding them for the long haul. Instead of trying to time the market or chase the latest fads, think about your investment strategy as a marathon, not a sprint. Look for companies that have a competitive advantage, a proven track record of growth, and a clear path to profitability. These are the companies that are likely to thrive in the long term, regardless of short-term market swings. Of course, this approach requires patience and discipline. You may need to weather some storms and resist the temptation to panic sell when things get rough. But if you can stay focused on the big picture and trust in your investment thesis, you'll be well positioned to reap the rewards over time. And that's it! Those are Buffett's 5 guidelines for surviving a down market. Here's a quick summary of what we have discussed in this video. 1. Avoid selling at times of extreme fear. 2. You should seize the moment when it presents itself. 3. Think carefully about what you're actually purchasing. 4. Choose reputable corporations above bargain basement ones. Lastly, have a focus on the future and don't lose sight of the big picture. That's it for today. Thanks for watching. Don't forget to hit the like button if you enjoyed this video and click on subscribe if you wish to view more videos just like this one. See you in the next video, financial buddies!